Hello everyone, a warm welcome to you all in the session of Oliveboard. I hope you all are fine and doing well. So those who are watching, please confirm my audibility and visibility. I hope everything is fine. So yes, today we have to start our last unit of module C, that is deal structuring and financial strategies. So it is the last unit of module C, unit number 18, and the name of the unit is deal structuring, means how to structure the deal and financial strategies. See, we have seen how to value a corporate firm, okay? How to do a valuation in case of when the firm is of intangible assets. Then we have seen how to do the discounting with the methods discounting with the methods non-discounting, how to do the valuation of such firms, such businesses. Then after we have seen how to do the restructure of a company. Okay, some if any employee new employee joins the company, or if any kind of employee goes, okay, his for his with his retirement, okay, he leaves the company. So what is the restructure of that company? How to restructure the company? How to restructure the organization? Then we have seen if two companies are merged together, so what are the benefits they get? Okay, what are the defensive strategies are there? When two companies are amalgamated and they form the entirely a new entity, what are the things that may happen? If one acquirer company acquires the target company, what happens? All these things, all the scenario we have done in our module C. Now, last comes, okay, I have purchased your company, I have done the acquisition. Now, how will be the deal? Okay, the structure of the deal, how the deal is to be closed, how deal has to be done in the company. So, in this unit, we will be seeing about the deal structuring process. So, the very first process in the deal structuring is the negotiation. Negotiation means it is an agreement between the two parties. If one party will say that, okay, I will purchase my business at this value. The other party will say, no, I'm going to sell my business at this value. So, what are the negotiations? What are the agreements that occur between two parties? That is, the one is acquirer and the one who is a target for. Suppose again two companies are there. Okay, company ABC and company PQR. Now, company ABC and PQR, company ABC is what? It is a purchaser. And the best example for purchaser in terms of this unit, we can say that it is the acquirer. No. And this person is what? This person is, this company is a target company. And the owner is, this is the person who is the owner of this target company. And target company means the one who is being acquired in another one. So if the acquirer says that, okay, I will buy your company worth rupees 20 crore, and the target company owner says, no, I'm going to sell my company just rupees 18 crore. So definitely, okay, what this acquirer will say? The acquirer will say, okay, I will purchase your company. Okay, sorry, at 18 crore. It should be 18 crore over here. I will purchase your company at rupees 18 crore, and the what the seller will say, okay, that I will sell my company at 20 crore. Now, what happens in this situation? They both are not agreeing on the same fact. Okay, the agreement is very different. Okay, his agreement is different and his agreement is different. So negotiation is what? It is the agreement. Okay, okay, then both will say, okay, the proper thing is that let's come at 19 crore. Neither you nor me. Okay, let's close this deal at rupees 19 crore. I'm ready to sell my company at rupees 19 crore, and you should be ready to purchase the company at rupees 19 crore. So the deal should be at 19 crore. So this is the proper negotiation, a healthy negotiation between the purchaser, between the acquirer and the target company. So this is how the deal has done. This is how the deal takes place in every company. So negotiation and agreement between two parties, the acquirer and the target firms, specifying their rights, their obligations. Okay, the another one will say, okay, no, I have more assets. How can I sell my company in such a low value. Okay, I will sell my company at a high value. The purchaser will say, no, no, I'm not going to purchase your company at this value. Okay, you have many liabilities on you. So what happens? They will specify their rights, they will specify their obligations, and accordingly that they will come to a specific point of negotiable point, and then the deal will close. It is known as a deal. Clear this slide? Any doubt, anyone? Done? Now, what? Okay, once the deal has been closed, now next comes the payment and legal considerations. What are the payment and legal consideration? That the payment may be done in the form of cash. Okay, whether I will pay in form of cash, I will pay in form of shares, I will pay in form of check, I will pay in form of any common stock. Okay, so overall consideration is form of cash, common stock, or the combination of all these three things, or a debt. So basically, what happens if a company is being sold on the basis of shares? So there is the tax benefit is given to them. Okay, the tax benefit is given to them when the company purchases on the basis of the shares or the combination of any of these, all of the methods. Now, form of acquisition vehicle and post closing organization. Now next is, okay, if we will close the deal, what activities we have to take care in the consideration? Okay, the form of acquisition, the form of the closing of organization. Okay, what are the necessary steps have to be taken? Okay, that has to be followed. So all these are the necessary steps. The first is the cost and level of formalities. So at what cost? Okay, the deal is being closed in the organization. The ease with which ownership can be transferred. Ease means the easy thing on which the ownership can be transferred. I'm taking this in the form of cash, in the form of check, or I'm in the form of shares. So, what is easy for me? Now, the continuous existence of the organization. So the purchaser will sell that, okay, I don't want to purchase whole of your company. I just want help of your company. I don't want the full existence of your company. You should have your own existence. The existence should be continuous. Okay, you will be the owner of the company. Just I want a help from your company. Now, management control. After the deal has done, then I will ask who will be the new manager of this company. I will be the new manager, you will be the new manager, or we have to hire any third person for controlling its management. So who will be the new CEO, who will be the new CFO, who will be the new CTO? Means authority and responsibility will lie with whom? Then the convenience of obtaining financial support, that is how to get a financial support, because it is entirely a new company. So definitely we have to get financial support from everyone. Ease of assimilation into the system. The manager in which earnings shall be distributed means now earnings to be distributed in which manner? How much dividend will be given to the shareholder? What is the profit sharing ratio? What is XYZ ratio? So how the earnings will be distributed? The scope of individual responsibility, that is which person will take what kind of responsibility. Okay, like suppose there are many different persons, XYZ ABC. So this person is capable of doing this work, so we will organize responsibility accordingly. That, okay, so responsibility has to be bifurcated, they has to be distributed according to the expertise of the person. So the scope of individual responsibility, and at last is what? The taxation, the tax we have to pay. Okay, we should not use any kind of loophole in paying the tax. So everything is necessary after closing the deal. Once the deal has been closed, all these things you have to take into consideration when you're closing the deal. Done. Now, selecting suitable post-closing organization. Again, some few things. The acquiring company may opt for a structure that makes post-close integration easier, reduces the risk of target known and unknown liabilities. See, this line is very important. Again, what happens? Okay, see, I don't know what are my liabilities. Okay, two companies are there. One company is being one is a purchaser, and another one is target company. Now target company says I don't know my liabilities. Okay, I don't know the purchaser company will say I don't know my liabilities. So what happens? Okay, if any one company's liabilities are known, okay, Suppose if they both together come together, if they will both work together, so the liabilities which was earlier and after coming together, now the liabilities, what are they now? If we can easily find out the liabilities of the other company by deducting the earlier liability and the liabilities now. So with the help of that, if we come together and work, what are the new liabilities? So again, it minimizes risk and we can know our liabilities. Financial buyer can choose a holding company structure. See, what happens in this case is that financial buyer can choose a holding company. Means if there is financial buyer, okay, they will choose a holding company structure. So holding company structure means what? In the previous class I have made you clear the holding company. Holding company means a parent company. And what is the parent company? When the company is holding 51%, 50 or not 50, 51% or more than that, the shares 51% or more than that of another company, another subsidiary company, then that company becomes the parent company of the subsidiary company. So financial buyer can choose a holding company structure. They can choose SPAC structure. So in the coming tomorrow's class, we will be not tomorrow's, when we will start our module D. So at the last of the module D, we will be learning the SPAC. SPAC are these are some you can say special purpose acquisition companies. So basically, these companies are created, formulated for any specific purpose, and that specific purpose may be form of acquisition, maybe any amalgamation, any acquisition, basically. So financial buyer, so they can go for SPAC, they can choose any holding company. Now, if the value of the tax benefit is large, then again the risk is high. If the tax benefit is more, you have to pay more tax, then the risk will also be high. So, what is the best option in that case? In that case, we can do a joint venture. The joint venture is the best option if we don't want to pay more tax, if we don't want to bear more risk. So, joint venture is the best option. Joint venture is a type of, you can say, strategic alliance where two companies come with their expertise. They join, come with their expertise. So when two companies join together with their expertise, they come together with their expertise, and that is what joint venture. So now joint venture will become the best option when there is high risk. Now, different types of payment consideration we have discussed: cash, non-cash, that is on the basis of check, mixture of cash and stock, the shares, or the convertible securities. So, what are convertible securities? These are those securities which can be converted into equity later on. So, these are such type of securities. Next topic is important, that is tax reliefs and benefits in case of amalgamation in India. When two companies are amalgamating in India, okay, then what are the benefits they will get? What are the tax reliefs they will get in case of amalgamation? And that should be in India. So tax relief to the amalgamating company. First is exemption from capital gains. So they will get an exemption if any kind of capital gain occurs. Okay, so they are exempted from such kind of gains. And in which section it will come important? Section 47, clause 6. Allotment of shares in amalgamated company to the shares of amalgamating company means when one amalgamated company's share is being transferred to the shareholders of amalgamating company, the one which is amalgamating into the amalgamated company, then what are the benefits they will get? A tax relief they will get, and it will come in which section? 47, 6 and 49, subsection 2. Now, tax relief to the shareholders of the amalgamating companies, exemption from capital tax, that shareholders, and tax relief to the amalgamated company, carry forward and set of accumulated loss and unabsorbed depreciation. See, what happens? They basically get what? Capital gains. Okay, they get an exemption from capital gains. Now, suppose two companies are there, one is acquire and one is target. Okay, means both our companies are getting amalgamated and becoming what? A third unit. Mm. Suppose this company has occurred a very huge loss. This company has occurred a very huge loss. So what is the relief they have got? Okay, they have got a very huge. So now they have got the opportunity that they can carry forward their loss with or unabsorbed depreciation would be set up. That loss can be carry forward and unabsorbed depreciation would be set off. Would be set off. Okay. So this is the benefit. So all the basically these are the benefits that are given in case of amalgamated companies in India. Okay, and in case of tax relief. Tax relief to the amalgamated carry off instead of accumulated loss and unabsorbed depreciation. So if a company who is occurring a very huge loss and that company is being amalgamating, so unabsorbed depreciation would be set off and losses will be carried forward. But when this benefit will be given, this accumulated loss and unabsorbed depreciation, this benefit will be given when a company satisfies few conditions. Okay, few criteria when a company satisfies. Now, what are those criteria? But the benefits under this section with respect to unabsorbed depreciation and carry forward losses are available only if few conditions are satisfied. Now, what is the condition? The first condition is company owning an industrial undertaking. Company should be an industrial unit. A banking company referred in section 5C, it should come in section 5C of the Banking Regulation Act with any specified bank. Now, one or more public sector company or companies engaged in business of operation of aircraft. So any public sector company or if any business is being engaging in the operation of aircraft, then they can claim for this benefit. With whom? With one or more public sector company. Means one or more public sector companies or companies, if they are engaging in operation of aircraft with another companies, then they can claim for this benefit. Or specified bank means State Bank of India constituted under the State Bank of India Act. So any specified bank, that is the SBI Bank, the amalgamated company should be an Indian company. So all this benefit will only be provided when the company will be of Indian company. When the amalgamated company will be of an Indian company, no foreign company. Then only these benefit will be given to them. Clear? Why we will going to give the benefit to our to foreign countries? Okay, to foreign companies? No, we will give such benefit to only Indian company. Those Indian company who are being amalgamated, so for them these are the benefits. Clear? Any doubt to anyone till now? All these are very important slides. Now, next one topic is very important that is MAT. What is the full form of MAT? Minimum alternate tax. See, from the word itself, it is clear now. The clarity is given over here that is it is minimum. Minimum means the least amount. Alternate means the different opportunity we are getting and tax that we have to pay. See, what happens basically the companies what they do, this minimum alternate tax, okay, it is levied on those companies. Okay, basically what happens, see, company, for every company they have to pay the taxes. Now company, what the company does, let's suppose company makes a profit of 25 lakh. Let's suppose company has made a profit of 25 lakh. Now from this profit company has to pay tax. Okay, let's uh, let's take an example. Company has to pay a tax of uh, 3 lakh rupees. Okay, company has to pay a tax of 3 lakh rupees. Now what happens, what company will do, the cleverness of the company, see what the company will do, they will deduct unabsorbed depreciation in different kind of expenses. Okay, then any kind of loss. Okay, any kind of fire fire insurance loss. Okay, so the company will show all different kind of losses, and they will deduct 10 lakh rupees that I have been got such kind of losses. Okay. The previous losses which was set off, which was carry forward. Now the profit remained is 15 lakh. So this one was the set of losses, unabsorbed depreciation, all the losses. Now, what government will say, okay, you are getting 25 lakhs profit, okay, but you are setting off your previous losses, okay, or making extra more losses, extra more expenses to show me that you have only earned a profit of 50 lakhs. Now, in this 15 lakh profit, the company will have to pay less tax. If the company will pay less tax, then the government will be having in their hand a less tax. So what government has made, okay, you are clever, I am more clever than you. So government says that, okay, now let's levy this mat on every company. So day by day, okay, few days previously what happens, every company they follow the same tactic, they follow the same strategy for making their prices, for making their profits, for showing their profits in a very low, okay, at a low. So government, they say that, okay, let's levy MAT tax, that is minimum alternate tax. So now what happens, okay, general provision of tax or the minimum alternate tax, whichever is higher, you have to pay that amount. For example, on the general provision tax, let's take an example, the 3 lakh came, okay, and on MAT, the 6 lakh came. Now you have to pay 6 lakh rupees to the government. That is, whichever is more, you have to pay that. So all the benefits will be now, it will be transferred to the government. So this is what the government has done, and the rate of the tax is what, the 15%. Okay, suppose a company has made a 20 lakh profit. Okay, of this 20, okay, let's say in 2 crore profit, and of this 2 crore profit, company has to pay 15% of this 2 crore. So whatever amount will come, okay, 30 lakhs, so they have to pay to the government. Now, their general provision, let's take an example, general provision, okay, general tax provision, if they apply, they have to pay 12 lakhs profit. Let's take an example, they have to pay 12 lakhs profit. And from the MAT, the profit is what? The profit is more. Let's take 13 lakh. So now in this case, the company has to pay 13 lakh profit. Okay. The more, which one is more, the company has to pay that. But the government has said, okay, I will give you the credit. Don't worry. So MAT comes under 115 JB of the Indian Tax Act, levies MAT on a company if the amount of income tax payable under general provision of ITA is less than 15%. If it is less than 15%, then they have to pay the tax. But if suppose they have paid the tax, okay, it comes under more than 15%, like 17% or 19%. Still, what is levied to them? This 19% more amount. So government says that, okay, you have to pay me 15% here. And if the MAT comes more than 15%, let's take an suppose 17% or 18%, so I will give you the credit of 2% back. Okay, I will give you the credit of 2%. So you don't have to pay more than 15%. You can pay 15%, or yes, you can pay 15% of MAT. But if your general provisions are more than 15%, then you have to pay that. No MAT will be applied in this case. MAT will only be applied in that case when the general provision is less than the MAT provision. If general provision is more, they have to pay the more amount. So whichever is more, they have to pay, the company has to pay that amount to the government. Yes. Okay, so this was all for today. We have completed our unit number 18. So unit 18 is completed, the last unit of module C. And from tomorrow onwards, we will be starting our module D, that is hybrid finance. So let's meet tomorrow for ABFM. And now at 9 p.m. we have our one more class for ABM. So do join that session. Till then, take care, everyone. Goodbye. Keep studying. Keep watching.